They have. They're a technically driven trade, it would seem, in a bigger way over these last couple of weeks.
Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Always a treat to visit with you about ag related issues and agricultural markets. Well, here we are in the middle of the week, and I want to bring in Joe Camp. We'll talk about this market action that we have seen on Wednesday. Now, the question heading into today was, well, are we going to see follow through selling after the debacle we had late last week and early this week, or could the markets find some footing? We'll talk about that in just a second. I want to remind you to like these videos, share these videos with others, and make sure that you click on that bell icon down below so that we can notify you when we post new episodes. And again, we thank you so much for your support. Man, you have really helped us increase our audience just in the last week. It's been phenomenal thanks to your support. So thanks for helping to spread the word about our daily podcasts here. Joe Camp is with Comstock Investments. He joins us to take a look at Wednesday's trade. And Joe, at first glance, when I look at the markets, it seems like we came off of the levels that we had earlier in the morning. Do you consider this a fail today? What happened anyway?
In some sense, just eventually drifting lower like this. Particularly, you see the soybeans making a new low for the move. The small semblance of upside momentum that had been generated for a couple of days on corn being mostly given up here. So much tied to the outside financial markets, and it had been somewhat positive for the market again these last couple of days. Starting off this week, that you had that nervousness in equities, in particular, the unwinding of positions included in part these speculators that were wanting to move to cash, which means cover shorts in the grains, maybe some fresh buying too, and capital rotating into the mix. But overall, nothing to show that there's been a big turnaround, certainly not that it would change the technical landscape and those computer algorithms that we're watching held by the managed money folks. And, beyond that, knowing that it can be a good couple of day thing to be up in a hedge against, say, a stock market sell-off. But overall, if it's continued concern about the economy, then you're going to have that way on commodities, and the grains and livestock included overall. Certainly cattle this week, hogs too, all of a sudden today in a bigger way, responding to the nervousness of the outside markets and the economy. So all of a sudden, a lot going on.
Well, let's zoom in a little bit. Let's talk first about the grain market activity that we had. By the way, are you looking more at new crop corn, that would be December, and new crop soybeans in November, or are you looking at the nearby months yet?
A bit of both, because we know about there still being, and it varies by geography, but windows open where the end users are going to need to push for some old crop. There are going to be places that might not be as early going on harvest as others, where usually there's going to be needs for grain, particularly Western Corn Belt. That's where basis has been relatively firmer and reflective of relatively fewer old crop stocks compared to the East. But you also have just more and more volume, open interest into these new crop months now. So not only being technically important for that reason, leading the futures market, but being the focus that we've all pretty well transitioned toward, which is what's this next crop going to be? How big? And how are we going to use it?
In fact, yesterday, our daily podcast featured Shelley Pate Kearns from LSU Extension, and she talked about how they've been harvesting corn for 2 weeks already in Louisiana. It's already up into the northern part of the state. Seems like yields are a nice friendly surprise to producers out there. They are pretty happy with what they have seen, especially after the dry year they had last year. So, I mean, the harvest is only going to increase. And you and I were talking before we came on with before hitting the record button here, that if you look at a corn chart and a soybean chart, it seems like they're just kind of dragging the bottom of the barrel here right now. That's going to be hard to get away from that, isn't it? If we're really going to be ramping up the harvest activity now?
You're going to still have the charts saying, at least, that the path of least resistance is lower for these grains because of like today, again, the soybeans breaking down to new lows for the move and not having much below the market before you'd get back to these key 2020 lows and sort of pre-pandemic type marketing eras. If we take a look, if I could share this chart for longer picture soybeans, we've got futures here from just before 2008 to the present, and a scary looking chart for sure. Any way you look at it, giving up these recently elevated prices and heading down to a level where, again, you can see this gap below the market before you'd have any reasonable expectation of technical support. And that can come into play when we get down into the first single digits. It starts with that. One reason why we'd still keep some focus on the nearby September soybean futures contract is just simply because it's above $10 for now. It'll be the first potentially to probe its way into the $9 handle. And you've got these lows, again, down towards $8 that are pretty key in 2020. That just leaves simply a lot of room down. And for corn, a similar chart would show that down to basically the $3 even mark.
The thing that worries me too, longer term, I mean, we're going to be getting into harvest pressure here. And we're really, I mean, when you think about it, only a few weeks away from the start of South American planting season. Isn't that right?
That's right. It's a season that marches forward, no doubt. We can see this in any market. Wheat, for example, where you have this talk about the new crop harvest coming to fruition globally, and how the French wheat crop is going to be down to multi-decade lows, that you are going to have reductions in estimates as harvest eventually rolls forward further in Russia and Ukraine, Romania, Kazakhstan. But it's still the case that even tightening supplies ahead aren't enough currently to overpower the abundant old crop stocks that we're carrying. And so we do have a bit of a blurred transition into seasons, and wheat is probably that way more than the row crops, where we do have the North American, then flip towards the focus on South American season just ahead. So all of that's in play here and would seemingly be more negative. The only factor about it is this is a market that has been thinking about these things and pricing in potentially some of the more worst case type scenarios. The alternative would be, that we do have a bit of a letdown starting with our own crop, but then also a further realization of smaller South American crops, of those wheat crops, for example, in Europe and on into the Black Sea region. So a lot can change here to potentially adjust sentiment. But again, until we get one of those sparks, it's lower is the trend.
It seems like maybe one small life preserver that has been thrown at the grain markets is the potential for a weaker U.S. dollar against other currencies, and that may help to spark a little additional export demand. Have you seen any sign of that yet?
Yes, there's so much going on with the currency markets, linked to what we've seen in the stock market sell-off, the interest rates adjusting. You have this trigger of the Japanese yen carry trade, the yen strengthening and triggering some liquidation of assets like those that could potentially have been parked in the U.S. stock market. We have this idea of lowering interest rates, boosting or rather diminishing demand for the dollar and weighing on it further as monetary policy adjusts going forward. And that can boost grain exports for sure. It can also increase interest in commodity investment demand as a whole, because one fear for this market is that you start to lower rates, the dollar goes lower, and then we've got an inflation problem again. Potentially, that's because items like the grains have room to rebound here if that dollar does fall.
Now, coming over the horizon in the not too distant future here, we've got another WASDE report coming up. It'll be the August edition. It comes out on on Monday next week. So we're not very far away from it. There is some talk that maybe they will make some modifications based on some of the lost acres that we had this year, but we really don't know, do we?
We know that they will review acres, is what they've confirmed recently in a written statement. before that in meetings to tell us that they are reviewing the Farm Service Agency data in August for the first time. Seasonally, it would normally come later. We would still get the FSA spreadsheet or their report on acres after the report in August, but it would be the forward updates that were supposed to count into a bigger way items like prevent planting and eventually adjusting those crop losses harvested as a percentage of the total plantings for acreage. So that's something we know is needed to reconcile for that flooding and the damage there. And indeed, we have the estimates coming into the report looking for corn acres to come down. I have a graphic, a table here to throw up what I feel like are going to be the first glance numbers, right? What are corn and soybean yields in acres on this August report? They're both up for revision. Acres, again, as mentioned, because of the program filings being in a bigger way to the USDA NASS office. They're going to likely see again that those flooding issues, the prevent plant can weigh on corn acres here down from about 83 and a half last report to just under 83. So short of 500,000 acres is the estimate. Certainly room for surprise on that number for sure. The caution probably for analysts here would be that already corn acres were observed to be down more than 3.5 acres from last year. Soybeans, the flip side of that, where you have acres up from a year ago, but down probably just a little bit on the total harvested if you factor in what was lost there. Now the yields, that's the next wild card, right? And we know that this market for some time has been pricing in estimates above the USDA's so-called trend line estimates. Those are the previous estimates here at 181 and 52. Well, animus estimates on average have these yields going up slightly. You can see to 1.1 higher on the corn and 0.6 of a bushel higher on the soybeans. Both, again, would be record best yields.
Interesting stuff. All right, let's take a look at this livestock trade as well. You mentioned that on the open, and let's see what has taken place here. It was a rough ride on the cattle complex early this week, well, late last week and early this week. But have they finally stabilized? Have they found support, or is it still pretty tenuous yet?
There is some signs of support here in this market. I can show a feeder cattle chart, the extent of the break, and then this at least couple session bunch towards that low on, for one, declining volume. You can see that in the red bars, and a potential bottoming out for some of these stochastics that we're going to monitor. This is a chart that our senior economist, Dan Monarnacki, brought in front of the group and wondering about, at least in the near term, a break like this can be perceived as overdone enough that it attracts technical buyers. And the next question is about fundamental buyers. And that's what happens when you've got a sharp sell-off like this in the cattle market. I don't have it at hand, but something I included in last week's Comstock report was a look at the 15-minute chart, real up close, and to how the live cattle dove lower last week on Thursday when the stock market did. And it was nearly in tandem, including on Friday when there was a brief attempt to rebound and then ultimate fail at the close. This cattle market has been so closely tied to stocks, and for obvious reasons, this concern about consumer demand, and just simply because as well, it's the opposite of the grains. Whereas they rebounded those couple of days that the stock market was selling off, you've got speculators that have been net long in the cattle and they're rushing for the exit. They don't care necessarily that, again, the fundamentals of it now are seeing that the board is well underpriced compared to the cash trade in basically any benchmark we have, although we're going to very much test that here yet throughout the day and the rest of the week on this cash trade, which is, again, otherwise expected to hold up pretty resilient relative to this future sell-off.
I know for a long time it was trading independently, but Is the cattle market once again shackled to the economic news now in the equity markets?
It would seem in this instance, because of that pairing with the speculative long, they had built that up and maintained it in both the live cattle and the feeder cattle futures for the last several months. And it's just a simply risk off type reaction where you get the rush to the exit, like mentioned, not wanting to be the last one out. And like for feeder cattle, a relatively lighter type of volume trade where big moves can be sparked if there's less liquidity than maybe other markets. And you had a break like that, then it triggers stops plus algorithmic pile on type selling. All of that conspired to make it so that the cattle market was absolutely linked to the stock market and should generally remain that way again, aside from days where the stock market can calm down and then we can get back to thinking, where's the board at, where's the cash.
But it seems like we're still not going to be rebuilding that herd anytime soon.
No, and that's a part of what we learned to some disappointment on this last go around for cattle on feed, and these numbers to show us the portion of placements that are heifers, which had not risen by as much as we'd like to see it if we're going to expect or want to have herd expansion starting to build some traction yet in 2024 or not. We're still watching those things as generally a supportive feature when you have these numbers as tight as they yet remain.
Well, let's talk about the hog market then. Hogs, they kind of ignored the economic news late last week and early this week, and they're kind of traded in their own little orbit, haven't they, for at least about a week now?
They have. They're a technically driven trade, it would seem, in a bigger way over these last couple of weeks. As I bring up the October hog chart, we have it compared to its Bollinger Bands, the volatility measures in red, splitting around the 20-day moving average, which we tested and then lost support of potentially in today's close below it. And that's a potential end of the corrective rally that you can see extending from those high 60s type lows that we had not but a couple of months ago. You have overall the speculators covering their short positions that they held, but then not wanting to turn long in a big way, and maybe here lately just wanting to exit that market too, along with the cattle, to respect the economy worries. So it's a technically driven trade that seems to have lost some steam. I paired that, by the way, just to reference the chart, with a simple moving average convergence divergence MACD indicator, and we can see this potential bearish cross under occurring again, where that blue line's not only dropping into negative territory but coming under the red and showing this lost momentum and maybe return towards a broader downtrend. Same with the cattle, though. The technicals are one thing, and it gets to a point where the futures can look really cheap relative to the cash, and even the cash index, which these contracts settle on, and that would be the thought for now, is that we've come down in enough of a way on today's break, in particular, that we're back to having some support with that discount to cash and where we see the pork cutout.
Okay, we were talking earlier about the fact that the Dow, for example, it looked like it was rallying today on Wednesday, and by the time we got to the close of the ag trade, it had reversed. It went lower. As we're recording this, it is still significantly lower on the day. If that would fail, would that open up potential for another leg down? And if so, what would that mean for the ag trade?
It would open up the potential for another leg lower for stocks and for all markets. You have the potential contagion here, and how we know these sell-offs occur, and even recessions to an extent, being a self-fulfilling prophecy. And it's a worry that is not over, and you can tell that from the reversal today, and even the move down from highs in yesterday's session, the first rebound after the 3 big down days. if we put it into perspective, we still got these major stock indexes like the Dow Jones or even the S&P that have not fully entered even that simple measure of corrective territory, down 10% from their recent highs. Well, it maybe helps to be reminded too, these recent highs were all-time highs that were achieved again, last month. And so these stock market corrections can be pretty scary, and we're likely, as we see this afternoon, not finished with the fear and the panic. But overall, is something that we got to watch out for as a risk-off influence for everything. And again, that includes the livestock, which we know are directly tied to it, and the grains, which after they briefly rebound, maybe for some short covering or unwinding type bounces, can be under that weight of sell everything, risk off, the economy is going down type of worry. So it's a concern here.
Well, Joe, thanks for taking time to explain everything about what took place on Wednesday and where we really are amidst everything. We're coming toward the end of the growing season, but now the economic news seems to be taking over, and it's good to stay on top of it. Thank you very much, Joe Camp of Comstock Investments. That'll do it for this episode. Thanks again for joining us. For producer Brianne Hendrickson, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.